Management Accounting 22A, Marginal Revenue and Marginal Cost, Inventory Turnover and Profit. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, St. Louis Test Prep, and our LinkedIn group, MBA Accounting and Finance. So let's talk about marginal revenue and marginal cost. And the issue here is, in a competitive market, a firm may need to reduce prices to increase sales. And the question is it worth it? That is, what do I gain by cutting the price and possibly incurring more expenses? So let's go with some definitions first of all. Marginal revenue, the additional revenue from selling an additional unit, one additional unit. Marginal cost, the additional cost from selling one additional unit. And so, I have a template here, and it's an easy thing to set up to understand this concept. We've got units sold, price per unit, we multiply the two together, A times B, and we get our total revenue in the first line, $500. And what we see happening is that as we sell more units, we're decreasing the price. And in fact, said a better way, we're decreasing the price per unit to increase units sold. So our total revenue is going up, but then we have the marginal revenue column, which is Z, which is the difference between the revenue from selling 11 units in this example versus 10. So by selling one more unit from 10 to 11, I get $39 more in revenue, from $500 total revenue to $539. I made up an additional cost of $35. So if I move my sales from 10 to 11 units and I cut the price from $50 down to $49, which generates the additional sale, my marginal revenue goes up by $39. I'm assuming that marginal cost goes up $35, so it's worth it to sell one additional unit at a lower price. I end up gaining $4, the difference between the marginal revenue $39 and the marginal cost $35. So I do it again. Cut the price, sell one more unit, total revenue goes up. The difference between the total revenue is $37. Let's assume the marginal cost is $36. I'm still $1 better off. 37 marginal revenue, 36 marginal cost. But at some point, and that point is at 13 units, it's not worth it to lower the price again to sell an additional unit. In this case, we lower the price per unit from 48 to 47. We sell one more unit. Our total revenue goes up. The difference between revenue before and after is $35. But if my marginal cost was $37, I'd end up losing $2 on the sale of that additional unit. So it's not worth it at 13. And in fact, which level of production maximizes profit? It's 11 units sold, because at 11 units, I increase my marginal revenue less cost is $4 higher. That's better than 12 units or 13 units. Why? The marginal revenue less marginal cost is highest at 11 units sold. So what's the effect on turnover? What's the effect of turnover on profit? And the issue is, we consider not only contribution margin per unit, which is sales minus variable cost, but how many units we sell at that price. How many units we sell at that price. So the question really is, am I more profitable selling more units at a lower contribution margin per unit? Or should I just keep the prices where they are, have the higher contribution margin, and be better off? So here's an example. Let's talk about Macy's, a department store, and a discounter. They're both selling the same product. The retail price is $4 for Macy's and $3.50 for Walmart. They both have the same variable cost because they're buying from the same supplier. So Macy's contribution margin, price less variable cost, is $1. Walmart's is only 50 cents. But Walmart, not surprisingly, sells a lot more units. They sell 22,000 versus 10,000 for Macy's. So even though the contribution for Walmart is smaller, the total contribution to profit, contribution margin, is larger. Why? Because they're simply selling a lot more units. Even though there's a thinner margin, a thinner contribution margin, they're better off. So all companies go through this analysis. Is it worth reducing the price to create additional units sold so that marginal revenue is greater than marginal cost? And the question is, where is that perfect, magic, most profitable level of units sold? In this example, it happened to be 11 units, created the greatest profit, marginal revenue less marginal cost. In the same way, all companies are doing that same analysis, and Walmart decides, well, at $3.50 we're going to draw so much more units sold that net we're going to end up with an $11,000 contribution margin. Macy's is not willing to cut the price that much for whatever reason. They're selling fewer units, and in total they have a less of a contribution to profit compared to Walmart. That's the end of Management 22A. We have our video textbooks, 30-minute, 1-hour videos recorded on accounting topics. You can go to the website here to find out about those. We have spreadsheet templates for our YouTube videos. For one-on-one tutoring online, here's the email address and the phone number. And coming up this summer, you'll see the summer series live chats on our most requested topics. And there's a YouTube video out there on our channel about the summer series, Wednesday nights and Saturday mornings all summer. Thanks very much, and we'll see you next time.